Welcome to the long game. I'm Nathan Carter, and just so you know, this voice is AI generated, but every word is written with care to bring you real insight in a way that's calm, clear, and worth your time. Today, we're diving into something that sits at the very heart of wise investing. Not a tactic, not a strategy, but a mindset. A way of seeing the world and your place in it. If you understand this one idea, it will change how you invest. But more than that, it might change how you live. Here it is. Stop thinking of yourself as someone buying stocks. Start thinking of yourself as someone buying businesses. Because that one shift from speculator to owner is the difference between chasing noise and building something real. Let me take you into a simple story. Imagine you're walking down a street in your hometown. There's a small coffee shop on the corner. You've been there before. The coffee's good, the atmosphere is warm, the barista remembers your name. Now imagine this. Someone offers you the chance to become a part owner of that shop. Not just as a customer, but as someone who shares in the profits, as someone who can help shape its future. What questions would you ask? You'd probably want to know, how much revenue does it make per day? What are the monthly costs? Who are the regulars? Is the lease secure? Is the owner honest? Do the employees show up on time? You'd think deeply. You'd want to understand. Now, let me ask you, when was the last time you asked those kinds of questions before buying a stock? Because that's what a stock really is. Not a lottery ticket, not a day trading chip, but a slice of a business. With real people, real risks, real potential. The stock market is full of distractions. Prices flash, charts rise and fall, headlines scream. But underneath it all, there are businesses. Some thrive, some fail. Some are built to last, others are built to look good just long enough to sell. And when you think like an owner, you start to see the difference. Let's bring this back to a real example. Let's talk about Nike. Most people know Nike for its shoes, its swoosh, its ads. But if you think like an owner, you ask a different set of questions. What drives Nike's long-term success? Is it brand loyalty? Is it the athlete endorsements? Is it global distribution? How does Nike compare to its competitors? What's its pricing power? How resilient is it during economic downturns? When you look beneath the surface, you see that Nike is more than a company that sells sneakers. It's a global brand that has built emotional loyalty across generations. That kind of strength doesn't come from short-term hype. It comes from a culture, from consistency, from strategic leadership. Now let's contrast this. Imagine you hear a hot tip about a small biotech stock. It just had a spike. People say it's going to double next week. You jump in without understanding what they even sell, who's on their board, what the cash flow looks like, or how competitive the market is. That's not ownership. That's gambling. And here's the deeper truth. When you think like a speculator, you behave like one. You become anxious. You check prices constantly. You overreact to news. You celebrate random gains and panic at sudden drops. But when you think like an owner, your perspective changes. You don't panic when the price dips. You don't celebrate without reason. You focus on performance, not popularity. Think of Jeff Bezos. When he was building Amazon, he wasn't watching the stock chart every morning. He was thinking about delivery times, customer satisfaction, inventory systems, data infrastructure. He was thinking like an owner.
And that's how long-term success is built. So let me ask you a question, one that value investors ask themselves often. If the stock market shut down tomorrow for 5 years, would you still want to own this business? It's a powerful filter. If the answer is no, you're probably not thinking like an owner. You're just renting a stock for a quick flip. Let's say you bought shares in Costco. Would you be okay holding them, even if you couldn't sell for 5 years? Well, here's what you'd see. You'd see a company with a strong business model, bulk sales, member loyalty, low margins, high volume. You'd see repeat customers. You'd see steady cash flow. You'd see leadership that avoids flashy risks and focuses on operational excellence. That's an owner's mindset. Now, thinking like an owner also means being comfortable with imperfection. Every business has flaws, even great ones. Apple faces supply chain issues. Microsoft has regulatory pressure. Google has antitrust concerns. Amazon has labor and logistics challenges. But when you think like an owner, you don't abandon a business at the first sign of difficulty. You weigh the strengths against the risks. You ask, is the core still strong? Is the vision still clear? Because owners don't demand perfection. They look for resilience. Let's talk about another key part of the owner mindset: time horizon. Most traders think in days or weeks. Most investors think in months. Owners think in decades. When Warren Buffett bought shares of Coca-Cola in the late 1980s, he didn't buy because he thought it would rise in the next quarter. He bought because he believed people would still be drinking Coke 30 years later. And you know what? He was right. He understood the brand, the distribution network, the simplicity of the product, and the emotional connection people have with it. When you think long-term, you don't just make better decisions, you sleep better. Let me say that again. When you think long-term, you sleep better. Because you're not chasing, you're not reacting, you're building. Now, this mindset also helps you resist another powerful trap: following the crowd. In the stock market, the crowd is often wrong at turning points. They panic at the bottom. They get greedy at the top. But owners don't take their cues from the crowd. They take their cues from the fundamentals. Let's bring in a metaphor. Imagine you own a small farm. One day, a neighbor offers to buy it from you for half what it's worth because there's a rumor the rain won't come this year. Do you sell? Then the next day, another neighbor says he'll pay double because he heard a new road might come through. Do you sell now? No. You say, "Thank you for your offer, but I'm not selling. This farm feeds my family. I know its soil, I know its cycles, I know its value." That's how value investors think. That's how business owners think. They don't let emotion dictate their decisions. They let knowledge do that. So if you want to be a better investor, start asking better questions. Don't ask, "What's hot right now?" Ask, "What business would I be proud to own? What company would I feel safe holding through a storm? What enterprise makes money in a way I understand?" And when you find something like that, don't just buy the stock. Adopt the mindset. Become a part owner. Think like someone responsible for the future of that company. Watch how that changes your behavior. You'll stop flipping. You'll start studying. You'll stop panicking. You'll start preparing. You'll stop wondering what everyone else is doing. You'll start focusing on what matters. In part 2, we'll take this further. We'll look at how to evaluate companies the way real business owners do, from competitive advantages to leadership, from pricing power to long-term risks. We'll also walk through how to build a portfolio that reflects your values, your goals, and your understanding, not just a mix of tickers you saw on the news. But for now, let this settle. Thinking like an owner isn't a small change. It's everything. It's the difference between watching your wealth swing wildly and watching it grow with patience and purpose. Thank you for listening to The Long Game. I'm Nathan Carter. I'll see you in Part 2. And remember, the market gives you prices, but only you can decide what something's truly worth.
Welcome back to The Long Game. I'm Nathan Carter. And just so you know, this voice is AI generated, but the thoughts and insights are crafted for you with care and intention. In Part 1, we talked about a mindset shift that changes everything. The idea that you're not just buying a stock, you're buying a business. And the moment you see yourself not as a ticket buyer, but as a part owner, you stop reacting and start thinking. Today, in Part 2, we'll go deeper. We'll learn how to look at companies the way real business owners do. We'll explore questions that matter. How do you tell if a business is strong underneath the surface? How do you judge the people running it? And how do you build a portfolio that reflects ownership, not speculation? Let's begin with the foundation of any good business: how it makes money. Now, that might sound obvious, but you'd be surprised how many investors skip this step. They hear a company name, they see the stock going up, they buy. But when you think like an owner, you stop and ask, what is this company's business model? Who pays them? What do they sell? And how reliable is that money? Let's take Microsoft. Most people think of Windows or maybe Excel and PowerPoint. But when you look closer, you see that Microsoft today makes a large share of its income from cloud computing, through Azure, from software subscriptions like Microsoft 365, from enterprise services, helping huge companies run securely. What does that mean? It means recurring revenue. It means contracts that last for years. It means predictable cash flow, even during rough times. That's what you want as an owner. Something steady, something you can count on. Now compare that to a company whose income depends entirely on one product, say a seasonal fashion brand. If that product flops, the entire company might take a hit. Owners ask, is this business resilient? Can it survive a bad quarter? Can it survive a change in trends? Can it outlast a crisis? When COVID hit, a lot of companies struggled, but others, like Amazon, adapted quickly. They leaned into logistics. They scaled their infrastructure. They served a new wave of online shoppers. That's adaptability. That's strength. But financials aren't enough. The next thing owners look at is the moat. We touched on this last time. A moat is anything that makes it hard for competitors to copy or crush you. It might be brand, like Apple. It might be network effects, like Facebook or LinkedIn, where the more people who use it, the more valuable it becomes. It might be scale, like Walmart, which can charge lower prices because it buys in bulk. Ask yourself, if I started a new company today, could I beat this one? If the answer is not easily, you might be looking at a strong moat. Let's take Visa.
At first glance, it might seem like a boring payment company. But step back. Visa isn't a bank. It doesn't lend money. It just processes payments. But it does that across billions of transactions with near-perfect uptime around the globe. You swipe your card, it works. That's Visa. And guess what? Every time it happens, they get a tiny cut. Multiply that by every store, every country, every moment, and you've got a business with a wide moat. Very few can compete with that kind of trust and infrastructure. Now on to the people running the business. This is one of the hardest things to evaluate, but it's critical. When you buy stock, you're trusting the leadership team with your money. You're giving them the keys to drive your part of the business forward. So ask, do they have integrity? Are they transparent? Do they think long-term? Let me tell you about Satya Nadella, the CEO of Microsoft. When he took over in 2014, Microsoft was seen as powerful but slow. It had missed the mobile wave. It was focused inward. People doubted its future. But Nadella changed the culture. He shifted the company toward cloud services. He embraced openness, allowing Microsoft tools on iOS and Android. He focused on developers, collaboration, and purpose. And look what happened. Microsoft not only survived, it flourished. Its stock rose, its products improved, and its relevance returned. That's leadership. Owners pay attention to leadership because a great product can fail under poor management, and a good team can turn around a struggling company. Now let's talk about something less exciting but incredibly important: balance sheets. Yes, the words balance sheet might make your eyes glaze over. But here's a better way to think about it. A company's balance sheet is like its health record. It tells you what it owns, what it owes, and how much breathing room it has. Owners want to know, does this business have too much debt? Does it have enough cash to get through a rough patch? Let's use Apple again. Apple sits on massive cash reserves. That gives it flexibility. It can invest. It can weather economic storms. It can buy back shares, increase dividends, or make strategic acquisitions. A weak balance sheet, on the other hand, is like a house built on sand. When a storm comes, it collapses. So don't skip the boring part. Even the strongest brand can get pulled under by poor financial discipline. Now that we've looked at how to judge a company, let's shift to a higher level. How do you build a portfolio as an owner? First, avoid clutter. You don't need 50 or 100 stocks. You're not trying to be a mutual fund. Instead, choose companies you understand, ones you could explain to a friend in plain English, ones you'd feel proud to own for a decade. Think of your portfolio like a small team of athletes. You don't need everyone to be perfect, but each one should bring something unique, strong, and reliable. Also, don't overweight your emotions. It's easy to fall in love with a brand, but love is not analysis. You need evidence. You need clarity. You need discipline. And above all, you need patience. Value investing doesn't give instant gratification. Sometimes you'll buy a company and it'll stay flat for months. Sometimes the market won't recognize the value you see. But remember, you're not here to impress the crowd. You're here to build wealth that lasts. So be still, be focused, be steady. Let's wrap up with this idea. Ownership creates responsibility. When you think like an owner, you become more thoughtful, not just about money, but about the kind of businesses you want to be a part of. You start to care about sustainability, about ethics, about how companies treat their employees, their customers, and their communities. Because you're not just investing in products, you're investing in people, in values, in futures. The stock market is full of noise, but beneath that noise are businesses, some small, some massive, all working, building, growing. When you invest with the heart of an owner, you're not chasing highs, you're planting roots. You're saying, I believe in this company. I understand what it does. I know what it's worth, and I trust the path it's on. And that belief, grounded in reason, not hype, is one of the most powerful forces in investing. Thank you for joining me for this episode of The Long Game. I'm Nathan Carter. Keep thinking long-term. Keep thinking like an owner. And I'll see you in the next episode. Because the more you understand what you own, the less you fear what the market does.